When should I use tax loss harvesting for year-end tax breaks? Imagine turning a market downturn into a smart move that saves you money on taxes. That's what tax loss harvesting is all about. It's a way to make your investments work harder for your family's financial goals. As the year wraps up, many investors start thinking about how to lower their tax bills. But the right timing can make a big difference. Tax loss harvesting involves selling investments that have lost value. When you do this, you realize a loss that can offset your capital gains from other investments. If your losses are bigger than your gains, you can use up to $3,000 of those losses to reduce your ordinary income, like wages or business earnings. Any leftover losses can be carried forward to future years, helping you save on taxes down the line. The best time to consider tax loss harvesting is when you see your investments have declined in value. Often, this happens during market dips or volatility. You don't have to wait until December to act. If you notice losses earlier in the year, you can sell those investments and lock in the tax benefits sooner. This can give you more flexibility to plan your overall tax strategy. Year-end is a common time to review your entire investment portfolio. If you've made significant capital gains during the year, harvesting losses now can help offset those gains. This means you pay less in taxes on your profits. Even if you've already taken some losses earlier in the year, you can still do more at the end of December to fine-tune your tax situation. Remember, tax loss harvesting only applies to taxable investment accounts. It doesn't work in tax-advantaged accounts like individual retirement accounts or 401(k) plans. If you have multiple accounts or family members with different tax brackets, coordinating your losses can maximize your overall savings. For example, selling underperforming stocks in your taxable account can free up funds to reinvest in better opportunities, all while lowering your tax bill. Timing is key. If you wait too long, you might miss out on opportunities to realize losses when markets dip. Acting during the year can give you a head start. But at the same time, doing a thorough review at the end of the year helps you see the full picture. This way, you can decide how much loss harvesting is needed to offset your gains. It's also important to follow the IRS wash sale rule. This rule says you cannot buy the same or a very similar investment within 30 days before or after selling it for a loss. Violating this rule means you can't claim the loss on your taxes. So, if you sell a stock at a loss, consider reinvesting in a different but similar investment to stay aligned with your goals. In the end, tax loss harvesting is a tool to help you keep more of your investment gains. It's especially useful at year-end, but staying aware of losses throughout the year can give you more chances to act. Always keep your long-term goals in mind and consult a tax professional if you're unsure about specific investments or complex situations. When you include this strategy as part of your annual review, it can make a real difference in your family's financial future.